Welcome back. Earlier today, manufacturing numbers were released, not with a tremendous surprise. However, there is quite a lot of movement in the bond market. I wanted to take just a few minutes to talk about what's happening in the U.S. Treasury market. The 10-year bond yield currently stands at a 334. The 3-month yield, the 3-month bond has a 466. We see 130 basis point inversion, where you get 130 some odd points, or basis points I should say, 1.3% more for buying a 3-month bond than you do for buying a 10-year bond. Now we know that when bond yields go up, it's actually the interest rates, or I should say the prices, that are going down. There's an inverse correlation. Now, we don't really see that we're selling the short-term bonds. It's that they're buying the longer-term bonds. They're buying a lot more of the 10 years and the 5 years because maybe, and this is just speculation, but maybe there's not a lot of real confidence in the near-term future. That maybe it's more likely that we want to hide our money in a little bit longer-term maturities than in the immediate future. For example, we have here, this is a 1-month percentage change in the bonds. Take a look what happened with the 2-year. The yield is down 24%. So we can infer that because the yield is down, there's actually been a lot of buying. The yield on the 3-year is down about 24%, the 5-year 22%. What's not down in terms of the yield change? The 1, 2, 3 month. That the traders maybe don't really want to buy the short-term bonds right now. They're placing the money into longer-term bonds. This is what's happened over the past month. Now, you'll notice the top lines over here that offer the highest yield. The 4-month, that's the red dotted line. That's at a 4.9%. We have the solid purple line here. That's a 3-month at a 488. That's followed by the 2-month at a 480. That's followed by the 1-month at a 466. And that's followed by a 4.5% yield on the 1 year. Now, all of these highest paying maturities are in the shortest term, or highest yields are offered in the shortest term maturities. The longer maturities are going down, and we're seeing a real separation here between all the yields that have less than 1 year, 1 year or less in maturity, as opposed to the 2-year to 384. We see the 20-year to 372. We see the 3-year to 360. So on forth, all the way down to the 10-year to 343. So the point being is that the money is flowing into the longer-term maturities. Read a little bit earlier today that there's a growing anticipation the Federal Reserve is going to continue raising interest rates because although we see a little bit of a waning in inflation and energy prices have subsided to some extent, they don't want to take their foot off the gas pedal, so to speak. And that maybe is driving the movement in funds to longer term maturities. Take a look at the 1 year versus 10-year. The 1 year is a red line, the black line is a 10-year, and the blue histogram bars here show us the inversion. We currently stand, the 1 year pays about a 117 basis points more for the 1 year than it does for the 10-year. And we can see the rate of change over the past 30 days. See these histogram bars? This shows us how much faster the 10-year is going down more than the 1 year. And the reason why it's important that we notice which yield is going down faster is because we spoke about this a couple of videos ago in terms of the history of the inverted bond market. Inverted bond markets tend to end when the short-term bond, the 1 year, accelerates lower and crosses back below the black line. That's not happening yet. This is what happened in 2007. We see here the black line is a 10-year, the red line is a 1 year. We did have an inverted bond market. 2007, all of a sudden the 1 year yield collapsed below the black line. This also took place in the year 2000. The 1 year, the red line, collapsed below the black line, the 10-year. That sparked the beginning of what we know as a stock market sell-offs in 2000 and 2007. But so far, that's not happening yet. We see the black line is a 10-year, the red line is 1 year, and if anything, we see the opposites happening right now, that the black line, the 10-year, is moving down more. We want to see if we're anticipating the same sort of pattern to repeat itself, we want to see this red line go down. So it's not changing yet. It's very difficult to say what this means, but I would venture a guess that the current market condition will persist because it doesn't look like anything's changing. If something changes in the bond market, it's logical to say maybe something will change in the stock market. But it looks like we still have a very deep inversion. Take a look at the 10 and 2 year, a very deep inversion with the 2 year at a 384 and the 10 year at a 385. So we still have about a 50 basis point inversion on that respect. So the same inverted bond market still holds true. And if anything, the longer term maturities are selling or going down more because capital is running into the longer term maturities. Perhaps that's anticipation of future rate hikes, and traders are moving their money accordingly. But we have jobs numbers coming up very soon, and that'll be certainly very, very interesting to see how that plays out in terms of the Treasury market. We hope this has been helpful. We look forward to seeing you back soon.